ahead. Former Fed head Paul Volcker is back in the news. He says he wants to see money market mutual funds treated the same as banks in regulatory terms. Let's get a quick take from our distinguished guests. Here to debate this question, Tony Carfang, partner at Treasury Strategies, and Peter Marisi, University of Maryland, and former chief economist, International Trade Commission. Gentlemen, here's the question. Yes or no? We're going to come back and deal with this in great depth, but yes or no for now. Should these money market mutual funds be regulated like banks? Peter, you first.
Absolutely. They pose large systemic risks and take on many of the same kinds of activities as banks.
And Ms. Carfang, what is your take on this, Anthony?
Larry, the funds are already tightly regulated by the SEC, and they're doing just fine. They don't need additional regulation.
You know what? I'm not a big regulator, but isn't the SEC sort of the dummies of regulation?
Well, Larry, the money fund regulations have withstood the test of time. Over the last 30 years, these have been rock-solid investments. In fact, the money fund regulations are now the envy of the world.
All right, we're going to come back and look at this. We've got to look at the Reserve Primary Fund, which was the money fund that went down last fall and helped trigger a world financial collapse. We'll have more of the debate. Stay with us. Kudlow Report. We'll be right back. All right, we're back with Tony Carfang and Peter Marisi. We're talking about a proposal to re-regulate money market funds. We've got just a full screen of some of the biggest funds in the country. Most of you out there probably invested one way or another in these money market funds. BlackRock, Fidelity, Vanguard, Federated. I think we got the big guys. I mean, everybody's in money funds. So, Peter Marisi, let me ask you this. How much money did the Reserve Primary Fund, which broke the buck, that meant that they had to default because the holdings that they were invested in commercial paper went down. This was last September. This was one of the key points of the whole financial meltdown. I don't know how much they lost. I don't know if you know. But how do we avoid another calamity like that, Peter?
Well, essentially, we have to ensure the deposits. When they broke the buck, there was a run on these money market funds, and the Treasury had to step in and essentially provide the equivalent of FDIC insurance. They don't have a reserve requirement quite the way banks do, so they can undercut the banks. So why not, if they're going to take deposits and loan money just the way banks do, you know, with primary lenders, then subject them to the same reserve requirements, level playing field. It will lower the return they receive, but it won't snuff them out. They'll still be a vital, important part of the commercial paper market.
Tony, I want to ask you, if you don't mind calling you Tony.
Sure.
It's a pretty good racket that these guys don't have to mark to market their Treasury bills and munis and commercial paper. So this whole business about the net asset value, which Peter called breaking the buck, they mark to the book value of the asset when it's scheduled to mature. Now, for trading instruments, that, you know, mark to market is the usual here. Maybe not for toxic assets, but in the main, doesn't this give money market mutual funds a tremendous advantage?
Well, Larry, a couple points here. First of all, the Reserve Primary Fund, to your earlier question, lost $785 million, which is a minuscule amount of the total $3.6 trillion in money market funds. I mean, you divide that out to 0.0001. And in fact, the collapse was caused by the collapse of Lehman Brothers, AIG, and everything else that was burning around it.
Right,
they own
the asset-backed commercial paper. That's what you're saying. And they may have owned the straight commercial paper. No, go ahead. I didn't know it was as low as $785 million. I mean, that's not nothing, but in the grand scheme of things, you're quite right. That's not a lot of money. So you think that the performance over time, you're not worried that this could happen again? I mean, they don't have lines of credit to the Fed, Tony, right? They don't have the kind of reserve requirements. They don't have the kind of regulatory oversight. You think that's okay?
Okay. The primary difference between money market funds and banks is the money market funds invest in very short-term instruments and instruments of only the very highest credit rating. So, in fact, the cost method of accounting in these funds keeps the net asset value at $1. Banks, on the other hand, perform a very valuable function, making intermediate and long-term loans. Banks make car loans. Banks make mortgages. These go out 5, 10, 20, 30 years. The longest investment that a money market mutual fund is currently allowed to make is 13 months.
Okay, hang on a second.
The weighted average investment is even shorter.
All right, let me get Peter in. Peter, do you agree with Anthony about the safety and soundness of the money market cash funds? I mean, $3.5 trillion worth. You know, everybody at one time or another is involved. I mean, the banks themselves own cash funds. J.P. Morgan owns big money market funds, too. Do you think they're as safe and sound as Anthony?
It's not a matter of whether they're as safe and sound as Anthony says. It's the fact that they can break the buck. The primary reserve fund was the second one to do it. And when it happened, because there was no backstop, there was no insurance program the way we have with banks, a lot of ordinary investors were threatening to pull their money out. There was a run on these things. So if we're going to have to guarantee them just the way we do banks, then we're going to have to come up with some reasonable reserve requirements as we do with banks. Now, if we want to start to classify financial institutions according to the kinds of loans they make and adjust reserves generally on that basis, I'm open to that. But the notion being that these guys have no reserve requirements, but the Treasury backs up their deposits, just like the bank, puts the banks at an incredible disadvantage, and it's grossly unfair.
Anthony, we're out of time, but just 15 seconds. Why don't money market funds set up insurance funds? They could do it voluntarily. Why not?
Well, there's no need to.
Real fast.
They manage their portfolio very short, and they maintain the net asset value.
All right.
There's no
Well, they
need
didn't.
to
Layman fair.
I got to leave it there.
Funds have failed.
I got to leave it there. You're both great. Anthony Carfang.
2 and 40 years.
Peter Marisi.